In this lesson, we will have a look at ratios. The specific objectives for this lesson is to explain the meaning of the term accounting ratios, to classify the accounting ratios into liquidity, efficiency, profitability, and solvency ratios, to define liquidity ratios, efficiency ratios, and profitability ratios, to calculate the liquidity ratios, efficiency ratios, and profitability ratios. Also, we need to explain the uses of liquidity ratios, efficiency ratios, and profitability ratios. We need to calculate the working capital and the effects of the transactions on it. And we need to make suggestions and recommendations for improving profitability and working capital. We also need to explain, calculate, and interpret solvency ratio. We also need to discuss the importance of accounting ratios to our owners, managers, trade creditors, lenders, employees, and potential investors or potential partners. Then we need to compare accounting ratios over time or with similar businesses to advise management. And then finally, we need to discuss the limitations of accounting ratios. So, quite a lot to do, so let's get started. Now, an accounting ratio is an analysis that shows how financial information is expressed. Now, there are 4 classifications of ratios. We have our solvency ratios. This is our solvency ratio. Then we have our liquidity ratios, which comprise of our current ratio and quick or liquid ratio. Then we have our efficiency ratios. These are rate of inventory turnover, creditors payment period, debtors collection period, and then we have our profitability ratios, which is our markup, our gross margin, our net profit margin, and our return on capital employed. Now, if we have a look at our liquidity ratios, our current ratio is there to check if the business is able to repay its short-term debts, and our quick ratio is there to check if the business is able to repay its short-term debts in case inventory is not sold. And both our quick ratio and current ratio is used to compare between the 2 different financial periods. Let's have a look at the formulae for our liquidity ratios. For our current ratio, it's our current assets over our current liabilities. And for our quick or liquid ratio, it's our current assets less inventory over our current liabilities. And our answer will generally look like this. It's X or a number to 1. The 1 always represents the liabilities. Now, the acceptable norm for our current ratio is 2 to 1, and for our quick ratio is 1 to 1. You can also write these ratios as the following. For current ratio, you can write current assets to current liabilities, and for our quick ratio, we can say current assets less inventory to current liabilities. Now, if we have a look at an example, the following information was extracted from the books of Wilma Luboni as at 30 April 2014. Now, what's required is to calculate the following ratios. We need to calculate the current ratio and we need to calculate the quick ratio. Now, our current ratio, we will take our current assets over our current liabilities. If we add up our current assets, we get 33,800. If we add up our current liabilities, we'll get 16,400. And then our answer is 2.0621. This means that our current assets covers our current liabilities by 2.06 times. Please note, don't just write 2.06. It needs to be 2.0621. The next one is our quick ratio. Our quick ratio is our current assets less our inventory over our current liabilities. So we already calculated our current assets, but now we need to subtract our inventory. Then if you take 33,800 less 18,500, we get 15,300, and our current liabilities will remain the same. Then our answer will be 0.93 to 1. This means that if inventory is removed from our current assets, then the business can cover its liabilities 0.93 times. Let's move on to efficiency ratios.